Good morning, everybody. Welcome back to our Tips for Mortgage video series. My name is Mike Parkinson. I'm a mortgage broker with Dominion Lending Centers in Campbell River, British Columbia, and joined by my cousin, Jaden Bax, who's a mortgage broker just outside of Calgary, Alberta with Avenue Financial. Good morning, Jay.
Good morning, buddy. How you doing today?
I'm doing good. Just excited to continue on with our video series. We're going to be talking today. This is our weekly rate update. Lots going on about this, lots of speculation. I guess a lot of concern from clients and people out there that just, kind of are following the narrative. And again, nobody knows what's going to happen. No crystal ball here, but when you start peeling things back, it just becomes really interesting. So we're going to talk a little bit about this. As you know, some of our bond yields have gone up in the last 3 or 4 days here because of what's happened with the announcements and strong job growth potentially. What are your thoughts on that?
Yeah, absolutely. And so, we saw that 150,000 new jobs in Canada, 10 times more than what was expected in January. And so just knocked it out of the park. For me, a lot of that is what, where does that narrative come from, and what is causing that? And there's two big things that are causing it in my mind. The government of Canada's immigration policy, which has brought in, record numbers of immigrants per year that are all coming here looking for jobs. And number two is the government of Canada's daycare policy, which, prices are getting higher. We are living in an inflated market. If you're on a variable, your mortgage is up. If you're renewing, your mortgage is definitely up. Your groceries are up, your gas is up, everything like that. All of a sudden, that one person income household can't afford it anymore. And it's more economical to put your kid into that, affordable daycare for a nominal price monthly, and both you go back to the workforce. So that's really, a lot of those people, I think a lot of that stuff is happening. But it's going to be interesting to see, jobs are interesting because, like you say, it's like the effect of interest rate hikes and everything like that. Jobs tends to be a lagging indicator, right? And so, how many of these jobs are going to be there 6 months from now, 9 months from now, 5 years from now? And that's the really interesting thing, right? But the problem with these reports is that it sure scares the market, doesn't it, Mike? And maybe talk about the impact of that a little bit.
Yeah, I mean, people are pretty nervous about what's happening with their mortgages, and understandably, this is the fastest they've raised rates in the last into an inverted yield curve, which is the main precursor of a recession. So they've raised rates the most they have in 40 years into an inverted yield curve, which has never really happened before. So what's that going to tell you? 6 to 12 months from now, we're going to see. I really believe we will see where we're going to be heading. It's going to be tough in the short term. Could interest rates go up a little bit here in the next, on March 8th, possibly, maybe a quarter point. But I still think my gut still tells me they'll just kind of pause because they know the lagging indicators are coming. Let's really peel back the jobs data. First of all, what type of jobs are they? Are they more service level, kind of like you were explaining a little bit, lower paying jobs? And another thing people don't understand is if the jobs market is so hot, then why, is the year over year average income gone down? So, for the last few months. So there's a lot of things to peel back of that. And what do we really believe? Are these numbers truly 100% accurate? No. So, I mean, the biggest thing is just trying to understand that what goes up eventually comes down. We just don't know when. We just don't know how much. Nobody has a crystal ball. I don't think anybody knows what's happening next week. This week. So I mean, we're just here to try to give you some ideas or things to think about behind the scenes instead of just believing everything that rates are going to continue to skyrocket, right? So, and the lagging indicator, like you said, we're just starting to see things filter through the economy now. It's been almost a year since they started increasing rates, and it has since they started cranking up rates, which was in May, and then summer, we're still not even there yet. So I think it's going to take 4 or 5 or 6 more months for things to really start to unwind. That's just my view.
Yeah, absolutely. And so, like, and so I want to talk about that inverted bond yield a little bit more. That is like absolutely every single recession has, like, the market just knows what's happening better than the government, better than the Bank of Canada, the Bank of England, any bank. The market knows. And so there's always this, and so when we say inverted bond yield, it basically means that you're getting paid more on a, let's say, a 1 2 year bond than you would on a, a 10 or a 5, right? And so even, but it's been really interesting to see, these kind of longer term bonds, 5 year, 10 year, all of that kind of stuff, have gone up quite significantly since this jobs report. But we're not seeing that filter through to the mortgage market just yet. Hey, Mike, like, usually the lenders will go up quickly with the bond market and then follow down a little bit slower. But because they've built in a little bit bigger of a gap between their pricing and what the bond pricing is, uh, they haven't reacted to this very, very quickly. What's gone over the last 3 or 4 days? Hey,
No, and like honestly, I was shocked that they didn't come down a bit more when the bond,
yeah,
longer term bond yields actually dropped quite a bit down in the last week or two. So we'll see. I'm sure that they won't take long to start bumping up a bit here, just because they go up much quicker than they come down. But again, let's talk a little bit about what's happening. Where everything's at, what our strategies are. I still have a lot of people taking a shorter term fixed rate if that's what they're interested in, even though the long term fixed rates are lower. So, you can do a 5 year fixed rate at much lower than 2 or 3 year. The 1 year fixed rate's quite high right now.
yeah.
But a lot of people are still in the same boat that, yeah, eventually rates have to come down. Like, they just can't stay up here this long, as we've talked about week after week. We just don't know when they're coming down and how much, but that's kind of a strategy now. And honestly, there's still people in variable rate mortgages that believe that a year and a half from now, they're going to be a much lower rate. So are you seeing that as well, Jay?
Yeah, absolutely. And I think for that person who wants a static payment, there's static payment variable rates, right? And so you can make that same payment, especially if you're coming in as a with a bigger down payment, or you're doing a switch transfer and you have a bunch of equity in your house. You can have that static payment and kind of ride the wave of what's happening with prime. Just knowing that there's a change between the principal and interest mix when prime changes, right? So, like Mike says, 5 year fixed is cheapest money out there right now, but we don't think it's the best value for over the 5 years, right? So, and if you're talking about longer terms than that, I don't know who the heck is locking into a 7 10 year term. I don't think that
Right.
exists right now, right?
Well, so what I say to people is, hey, if you want the 5 year because you can't sleep at night, no problem, right?
Yeah,
Let's try to find a lender that has maybe the best penalties on fixed rates. Be very careful what you're getting into. Make sure you understand the potential penalty down the road if you do break a fixed rate. If you're in a 5 year at say 4.5 or whatever it is, you're happy with today's rates.
yeah,
Okay, let's say a year and a half from now, rates are down to between 2 and 3% again. Are you going to be happy with that 4.5? Are you going to be happy that your penalty is 40 or 50 grand or whatever it
yeah.
could be, right? So these are just things to think about. We don't have a crystal ball again, you know. We're just throwing reality out there that if you look at the long-term history of interest rates, they've gone up, they come down, they go up, they come down. I just don't think society's set up for these high rates. Like, there's too much debt out there, and that's just my gut. But let's talk a little bit about inflation numbers now, Jay. We just saw that in the U.S., the CPI came out at 6.4%, where they were predicting 6.2. So there's all these narratives about, oh my God, things are, inflation's taken off again, and this and that, which I think it's going to be a bumpy road moving down until something happens. But just be really careful about that, about the true numbers and what's happening there. Canada's coming out, I believe, a week yesterday, the 21st. Their CPI
Yeah.
report coming out. So we'll do another video next week on that and what's happening there. So, but in the meantime, I think short-term rates are going to stay high. They could go up a little bit more, so you got to be prepared for that. But in the end of this year, second half of this year, and into next year, I think that's when I think we're going to start to see things, the narratives change. Again, that's just my thoughts. How about you, Jay?
Yeah, absolutely. And I think one of the things that, people are afraid to get into the market right now. And When we're doing our our calculations to pre-approve you, we're doing it based on rates being 2% above
Right.
what you would actually be paying, right?
Stress.
And so,
Yeah. Yeah.
so there's some room built in there, and I think what you got to see out there, housing prices, especially more so in your guys' area of the world, in BC there than in Alberta, but housing prices are starting to come down a little bit, and so even though rates are 4% more than they were a year ago, or 3.5%, whatever they are. If that house is back on the market that was a multiple offer situation, 70 grand over ask a year ago, it might have come down enough, even with these higher rates, that you're paying probably a similar mortgage to what you would have been paying about a year ago. So definitely worthwhile to see what's going on in the market, see what you can afford for monthly obligations. It might not be that different because the pricing has kind of offset the rates, right? So at any rate, if you're in the market looking to get into the market, if you have a switch transfer, which is hugely stressful for people in 2023, where your mortgage is up for renewal right now, and maybe you're going from a 2.5% to a 4.5%. Give us a call. We'd love to chat about all the different options. And it comes down to math and your comfort level, and we're really happy to talk through all of that. So thanks for joining us. Great to see you again, Mike. We'll see you next week.
You too. Thanks, Jay. Take care, everybody.
You too. Bye.